Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Hello, everyone. This is episode 40 of the New Barbarians podcast. Today is Monday, October 20th. The podcast will hit the platforms hopefully tonight. Today, we're joined by Vlad Stanev, co-founder and CEO of Quantly. Say hello, Vlad.
Hey, guys, and thanks for having me on, Mark and Bill. A pleasure to be here.
Of course.
So I actually have very little to say about markets because I didn't get my market update from Wolf Research like I usually do on Friday. And I rely heavily on that to recap factor performance. I'll assume that the market was still volatile and that the geopolitical landscape is still incredibly interesting, but I'll let Mark elaborate on that. So take it away, Mark.
Yeah, you betcha. Yeah, it definitely is dynamic. Just as we try to look for peace in the Middle East, Israel fires back at offenses by Hamas. So let's just say it's not all there. And, as late as I think Saturday and Sunday, we had, the Russia-Ukraine dialogue evolving where Ukraine has accepted terms of troops in place for a peace. But we're not here as a talking head, Bill. We never are. I am going to be able to share because I'm using Chrome, which is, usually I get that part wrong, but we're going to be able to share market insights. We're doing something different today, Bill. I'm springing it on you. And Vlad, it's kind of what we talked about earlier when we said, hey, why are we talking about a debasement trade when, Vlad's all about innovation and tech? Because it's all one water table. That's the major theme. It's why Bill and I ended up together on this podcast, him bringing up AI, which a year ago, Bill, as I keep saying, I had no idea it was going to be this big, and me just focusing on Bitcoin within digital. So here are themes. In a couple minutes, I'm going to try to make all these things work together. In markets, it was about safe havens versus small caps, fundamentals versus flows. And I want you guys to chime in and interrupt me over talk. It makes for good theater and also helps me keep on track. And then the events news, Bill, which you touched on is, yes, tariffs kicked off about 2 weeks ago. 50% wasn't enough. Let's go to 100% with China. November 1st is the deadline. So we're 10 days, 11 days away from that. Argentina, peanuts, cockroaches, and giants. We're all going to make it tie in these next 6, 7 slides. So we always start out with a scorecard. Who's doing what? And I chose a 1 year because I think that's the trend. And as Bill said, markets are interesting, which means that they're volatile, which means that you have a lot of factors punching and changing, say 1 week, 1 month trends differing from what we saw in the year. So here's what we have in the year. I think it really shows the full complexion of tariffs in April, tariffs in October, and what investors are still doing. Oil off, dollar off. That's the main sell trade. The U.S. wants it, Besant wants it. And where are investors going? The other side of the spectrum, into Bitcoin and gold. So the politics are driving dollar cheaper because that's what we need because we're consumers and we want to have those imports cheaper. And then oil's down because the growth picture. Our analyst in Austria just put out a wonderful piece on the whole calendar, and he led off with China, which I love. If you're not getting that link, it'll be in our show notes. It is a must. It is the best look global economic picture in the week. 200 metrics, he chooses 9, and he tells you why. So that's a little bullet for him. So this is a 1 year picture, pretty clear. Safe havens. Never seen gold and Bitcoin lead like this over a 12-month period ever. But it's very different when you look at the month-to-date. The month-to-date picture in the front here, 10% run in gold, which is over half of it's on its way to its 5-year average, which is 17%. Gold has been averaging 17%. More than NASDAQ, more than the S&P over the past 5 years. And it's just, Vlad, it's gone asymptotic just in the past couple of months here. Up 10% just this month. Bitcoin down 7%. We think that's the definition of fundamental picture is the 1 year graph we showed. And flows are driving what we're seeing month to date. So I'm waving off the information that we're getting from month to date, which says Bitcoin's no good. And I'm saying it's more about the 1 year, which is up 60%, the 5-year average up 57. So that's how we use time series in data. We like to look at, what the market's telling us, and then we like to use our fundamental data to try to substantiate and say, am I wrong? Is Bitcoin no longer going to be compounding at the rates it has? We think that's not the case. So on the themes of gold and peanuts, let's look at gold up here, hit 4,400 over the weekend. But look at silver. Silver breached 50 for the third time in its one history. Each time it collapsed, but gold has gone higher. So the gold-silver ratio, which has been as low as, say, 17 in 1980, 35 in the year 2011, it's at 82 or 83 right now. And the question is, will silver then expand up and go up to 150 with gold right here, which would be about the ratio it was in 2011? We think not. Industrial metal not being bought by central banks. So we think, again, silver may pop, but it'll underperform gold in this next cycle. And then I'm going to just cruise through these and try to get those connections made. This is just something I can't build. We had I was in Denver for a conference, Vlad, Bitcoin conference at a place called The Space that Bill, our former guest or previous guest, Wyatt O'Rourke runs. And everyone said that volatility was one of the biggest issues that people bring up. We just want to show that over the long term, Bitcoin volatility is trending lower. S&P volatility is trending higher. Again, the fundamentals that support our opinion, my opinion, as sort of the focus on Bitcoin and digital, is that Bitcoin has perseverance, it's anti-fragile. And now for peanuts. I've mentioned it 4 times. Over the weekend, there was an article that came out that doctors who had exposed children to peanuts in infancy developed immune ability so that they were a better immunity than those who were not exposed to it. So the whole idea about that was, if you want to raise children, the idea of being anti-fragile, introducing them to more hurdles or stresses in a controlled manner can be constructive. And that's what Bitcoin's done. Bitcoin is open. It's 24/7, 365, and it has an anti-fragile nature. So that might have been a little bit of a forced analogy, but that was my game, Bill. I told you I'd land the plane, even if it was maybe on one wheel. I have a bunch of other stuff. Let's just say Bitcoin ETFs. Investors are running into it. This is 1-month flows in blue into equity, bond, gold, and Bitcoin ETFs. Over the last month, on balance, BOO, IBV, and SPY, those are the 3 major equity ETFs. It's on balance, call it 1% of the flows of the AUM have flowed in over the past month. 1% on average. 3.5 for IBV because it's cheap, and virtually 0 for the rest. Really not meaningful. On the bond side, same thing, about 1%, not meaningful. Gold, close to 4% of the entire AUM flowed in the last month. Bitcoin, 5% of total AUM flowed in over the last month, which builds on the 1 year. Over a third of the AUM is in the last year for Bitcoin, and for gold and bonds, you see more of a safe haven. So it's totally been a safe haven trade. Bonds, gold more so, and Bitcoin, and all that's accelerating. So I'm going to stop here, Bill, on factors versus fundamentals. I think the flows have pointed to small cap, which you talked about last week, and value driving more recently, which is certainly not the case that we saw on a year-to-date basis, where large cap growth has been the monster, AKA Mag 7. So I don't know if that's a good time to kind of switch over to Vlad, but our thesis is that any business or technology that gives you more for less will be adopted because of our debt and deficit and lower growth. Every company and every person has to be either consuming that from a demand standpoint or has to be delivering it, or they're out of business. So that's the scoop.
Is that just the US there?
Yes.
I think it's quite interesting, actually, how the overall trend in growth, and I don't follow markets as closely as you guys anymore, but I think it's interesting to think about the implications of that as you sort of, and how that relates to also technology and also the promise of AI and the promise of all these trends that are developing. Because you're seeing the market going into safe haven assets because of political uncertainty, because of also the fact that markets are being quite frothy. I mean, majority of the growth is driven by the Max 7 and sort of large cap stocks, which basically means tech companies that are going through all these sort of financing deals across sort of data centers and with hyperscalers and compute. And it seems to me that the market is sort of starting to think, okay, is this going too far? Is this going too high? And that is alongside, of course, the political uncertainties and instabilities that are going on within the country, outside of the country as well. That's really sort of driving gold up and pushing it up so high. Where is that going to end? It's an interesting question. Where is is the S&P growth gonna flatten over time as sort of people are starting to think, okay, now where is the ROI? Where are the returns that have been promised by AI essentially? Because the majority of uptick in these valuations right now is basically driven on pretty much promise, I would say, and expectation of AGI and of huge productivity gains that are driven by these companies. Now, whether that's going to materialize, and also me being in the space, there is definitely promise, but it's definitely not a sure thing. So just interesting to see how it develops over the next sort of year or maybe even 2 years or so. 2 years might be too long, but as actually companies start promising, actually start delivering, and how much of this promise they can actually deliver is going to be really what makes or breaks this, I think.
Cool. And I'll properly introduce Vlad now. But I do need to reflect on those two notes there. One is I haven't looked at the evolution of the stock market and the fact that now we're in small cap growth and rotating out of large cap growth, and no one likes mid cap growth. So I think that is an interesting proxy for like the AI exposures that everyone's presumably looking for. So now I think people are looking to move out a little further on the risk curve, and like October is risk on, I think, despite all the volatility. So I don't really know what to say about that, but the US investor, and I guess this reflects global investment in the US anyway, but is moving further out on the risk curve, and it's probably, getting exposure to the newer AI companies, which I think is a good time to introduce Vlad.
And Bill, I'm going to put a dot on that part what you just said about Vlad started on, is AI delivering? And your point is there's a rotation going on. And in the data centers, we all know there's, CoreWeave and some other public data centers have market capitalizations of like tens of billions of dollars. The Bitcoin miners are now shifting their capacity, which is going to take anywhere from like 12 to 24 months, to data. And their market caps are up 3 to 5 times this year. Places like things like IREN, IREN, even Mero, the larger cap one. So yeah, we're totally seeing in that space where they're being sucked up into the larger market caps.
And that's also, I'm not sure what that trade is called, but it's like the second or third derivative of AI. And that's where I think investing will increasingly move, with so many things being data driven, and it's obvious how to predict certain things, but you need to predict the predictor, if that makes sense. And then you mentioned AGI, Vlad, which to us I think means autonomous general intelligence.
Pretty much artificial general intelligence.
So that's Terminator, and that freaks us out because we're freaked out by Terminator. I'll just
I mean, likewise, but I think we're pretty far away from that as we stand. A realistic perspective.
That's what they probably told John Connor when he was growing up. Don't worry about this. We're so far away from it. And then, you have some guy, creating the machine in some dark corner of the world, and then all of a sudden it just emerges. Anyway.
If that happens, then anyway, we can stop working. That's pretty much the end of it. Also, if it's in 2-3 years, then all we got to worry about is those 2-3 years, and then that's it.
Speak for yourself, man. I want to be valuable to the machines. I might join them, find a job with the I forget, the Skynet.
So you better keep saying please into ChatGPT as you prompt it.
I always do. I'm actually very polite, and I just hope that it's more efficient. I'm not too concerned about the actual machine waking up and realizing who's been nice. So anyway, Vlad, we'll just let you introduce yourself, but I'll say I met
We're not going to
you.
get there because we're going to keep introducing. The fact that interrupting, the fact that we just brought this up on a podcast about saying please to your chatbot, and then we gloss over it because we all know what that means. You find yourself saying please. I'm like, wait a minute, why am I doing this? It's bizarro how fast behaviors are changing and what we're interacting with. Back to Bill's point on someone in a room is making a machine and we're aware of it, and I don't know where it's going to happen, but I'm saying please to a chatbot that Sam Altman made. Bizarro. So I got to watch my own behavior. But yes, Vlad, enough of that. Tell people why we have you on the call here and how you fit into this whole arc of development in AI and AGI.
Thanks, Mark, and thanks, Bill, as well. So just a quick introduction on my end. So Vlad, co-founder and CEO of Quantly. And Quantly, ultimately, what we do is we build custom LLM systems for asset managers, for hedge funds, for banks, etc. And we actually, there's a lot to unpack around sort of everything that we touched on briefly as well. We started off as an AI agent platform where anyone can basically set up, log in, come in and just start automating their sort of investment research workflows, start setting up and building agents that basically do parts of their work. So the PM's work, the analysts work for them. We ended up moving away from that a little bit, and we can touch into that in this time in this podcast, but more sort of custom work and custom build. So taking our technology, actually the foundational technology that we've built to enable AI agents, to enable Gen AI use cases across firms, and actually going into individual firms and saying, okay, now we can leverage our technology to actually build something for you, to build a proprietary AI system that works specifically to your workflow, specifically to your investment thesis, specifically to sort of how you do work, because ultimately that's where the secret sauce lies. But before we go into that, just want to dive a little bit into my background. I think that could be useful. So background, university, studied economics in the UK. After that, just like pretty much everyone from an economics degree, we went into the city, so spent a few years in credit, doing credit research as an analyst at BNP Paribas, covered a number of sectors there, was one of the youngest people to cover a sector there on the credit side. And then after a few years, decided actually what I want to do really is I want to work with some of the new stuff that was coming out, sort of the new technologies that were developing. And I didn't really have the skill set for that. I did economics, and then I went into sort of credit research straight away. So did my master's again here in the UK. In data analytics and data science. During that time, actually was working with an AI startup and thought I actually might be helpful here. Started off as a side project to help them out with sort of financial data annotation, data gathering, building out data sets. And that ended up turning into my first company at the time. So spent 2 years or so building out a data annotation company specifically for financial data use cases. So working with financial data providers, some financial institutions, and also some AI startups in the space. Had the chance to sell that, had the chance to exit 2 years in. And then at that point, actually, sort of there was GPT-2 was already out. GPT-3 was coming out, and it was kind of obvious that this technology is pretty cool. And there's a lot of applications of this technology, not just in finance, but across all sorts of industries. But given my background sort of as an analyst and also then with financial data, that's really all I knew. And I think that is a perfect application to large language models. Actually making sense of data, synthesizing data, scaling a ton of manual research processes that pretty much anyone, at least on the fundamental side, does. It's pretty manual. So explored a bit and joined this startup accelerator called Entrepreneur First. And that's where I met my co-founder, Ivan, who you met recently, and that's how essentially we started Quantly. And that was now nearly 3 years ago. And we've never been more excited. Actually, every week, pretty much, we get more and more excited by the new stuff that's been coming out, and just see sort of whether that kills us or how do we use it to actually do what we do much better and still stay on the technical edge of the technology.
Cool. I guess credit to AI is an interesting move. I think in equities, there's been a link for quite some time between systematic investing and what people generally call quantitative, but credit's pretty far away from that. So it's interesting, like it sounds like with annotating documents and things like that, you were working on maybe deep dive type of credit research with these tools, or was it systematic, meaning automating some of the process that you would use to actually trade and invest in credit?
With credit, it was very much manual. I mean, as a credit analyst covering sort of high yield and IG credits, it's pretty much like the same workflows, the same work that a sell side equity research analyst would do. So we would create notes, we would dive into companies, we would sort of very diligently cover all the available information that's in there, etc. And the transition to AI was kind of, I would like to say, by accident. Really, it's not really sort of related to what I did in credit, but it's just sort of how things happened from my master's in data science, and then sort of slowly going into that space and then thinking, well, actually, what I did before can be a great application of the technology that we're sort of at the time toying around with, playing around with back then. And I think that's also part of the reason why things have been, or part of the reason why we've been doing well as a company and we've been developing great technologies, because there's a lot of techies that can build incredible technology. And there's a lot of analysts and PMs that understand the market and the use cases extremely well. But actually, the combination of those two things is something that's relatively rare. That's rare in industry, that's rare everywhere. And sort of that combination between building amazing tech, thanks to our team, actually, which are absolutely incredible, and understanding the use cases, having that domain knowledge of, okay, as an analyst, sort of what do I care about, or like what is my mindset when I'm thinking about a particular opportunity or sort of my portfolio, etc., or the book in our case. That's quite rare, and I think that's been one of the sort of the key ingredients into all this.
Bill, mind if I jump in with a question here for Vlad?
Of course.
Because thank you. As we have a bunch of analysts that work with us, both college interns, the City University of New York has given us 3 to 4 interns depending on the semester, and they get college credit. Managing that is tough because you got to put time in before you get value out. And we also have, again, someone in Austria, and we have a new analyst in California working with us. Is there a success story that you have about that innovative technology meeting that use case where someone, and if you do, what did they replace? How was their workflow different from Monday to Tuesday when you met with them?
I think that's actually sort of not rephrasing, but just answering your question through sort of a bit of a related example. Is that AI is transforming the industry, and it's really transforming how people work. At the moment, that's happening through, let me just sort of get information that I might manually look through, let me synthesize it, and let me sort of just do that very quickly in minutes as opposed to hours. It's nowhere near, for example, making investment decisions, and that's fine. That's right, actually. It shouldn't. It definitely shouldn't, at least for now. However, what senior analysts and portfolio managers are relying very much on is just their deep knowledge of the market, their experience just from being part of this of the market and doing this job for many years. They become experts intuitively into sort of the sectors they're covering, the asset class that they're trading, and this is something that's very difficult to just shortcut. So as a junior, you won't be able to do that, but what you are able to do is actually you're able to sort of fast as possible, and actually AI allows juniors to learn as fast as possible. And just as an example, or you have a portfolio manager. This is with one of our clients actually, and one of the main issues there is they're struggling. So juniors come in, interns come in, and one of the main complaints is, well, we actually don't get enough PM time. The PM is doing his thing, and I'm just kind of left by myself. So actually, what you can do with AI is you can actually have a system that sort of replicates or understands how the PM works, sort of having institutionalized that knowledge, and then the analyst actually working with that system to accelerate their learning without necessarily having a one-to-one sort of increase in time spent by the PM. So that's one way that AI can be used. Now, in terms of actual use cases, actual workflows, how things change, how sort of workflows change, well, there's two things there. One is, well, AI can replace one of the things that I do, which is, let's say, company coverage. And when I start to cover a new company, instead of doing it myself, now I can have an AI system do that for me. That, I would say, is actually the wrong use case of AI. The reason for that is because as a PM, as an analyst, what you're best at is actually diving into a company, understanding a company very well, and making an investment decision or a decision following that. Where AI can help, and that's where we're seeing sort of where workflows and just work is being transformed, is actually not replacing the stuff that analysts are best at. That should definitely stay with the analysts, but actually sort of doing the other side, sort of being an actual assistant. This is how I work. This is how I cover a company. Here, I've covered the company. I have my report. Now, what did I miss? What are the things that maybe are there, but I actually just glanced over or I didn't pay enough attention where I should have paid more attention. And that's where AI is the most effective. And actually, I'm kind of going on a tangent here, but one
No,
of the
I don't think you are. Just hold that thought. I don't think you are, because I just said that we have analysts all over the place and we're doing 1,000 things. If we can share an LLM, say it's Perplexity or whichever one, and we have different spaces within them that are modules that I like to look at, whether it be markets, whether it be about companies, like you said, and I'm working on it, the analysts can see how I'm prompting and the answers, and then they can better serve me without me being on the phone with them. So it's a way of leveraging myself in a mentorship program. I think isn't that is kind of what
exactly
you're
that's one way, but actually in many other ways, those junior analysts can actually help you on the other side. It's not only a one-to-one relationship where you sort of teach them and get them immersed into the job. Kids, people, the young people that have graduated, let's say, school or graduating college, they have over the past few years grown up with this technology, with whatever ChatGPT, Perplexity, etc. So they know very well how to, first of all, prompt it, how to leverage it, and also, and we have some examples of that, they can actually stress test it pretty well to the point where even myself, I can, because I have that sort of preconceived belief of I know what AI can do. So I should probably just ask it that, and then that's it. We have examples of even people, people in school using Quantly and developing sort of these ideas and like these sort of playbooks and methods that are pretty cool to see, and sort of things that you see and you're like, I didn't really think of that. Because they're sort of AI native, they can also teach you quite a lot. And over time, I think what we'll see within funds, within investment teams, is you're probably going to have, it's not going to be the sort of the 50-year-old portfolio manager that's for the first to adopt the technology. It's going to be actually some junior analysts that are sort of starting to adopt it and sort of pushing that technology into the team as well. So that's just another way of looking at things the other way around.
Cool. I'll recap this for a second, and then I do want to dive in a little bit more to how you can potentially help me. So I'm gonna make this a little selfish as well. But Mark and I both met you at the Gen AI and Investment Management Conference at Columbia a couple of weeks ago, and I think that's a good way to describe where some of this is shifting and what you guys were just talking about. So I think of Mark as like a deep fundamental analyst, primarily macro, but also like very broadly across risk. And he was in prime brokerage and had to look across all these different accounts, including the one I worked for. Automating things and using analytical tools was very much and now we're finding that, and this actually brings me all the way back to that like tangential question at the beginning. Like, I think what you're helping is primarily deep fundamentals, and your background in credit is actually appropriate for that. And it's different than systematic research. Like, we're looking to automate things. And in fact, a lot of times we have this reductionist workflow where we want to take a equity research analysts and reduce them to a time series. So we're classically like, let's convert everything they did in their head into like stock calls, buy and sell. We'll try and contextualize it and maybe add some more columns. But in systematic research, it's very reductionist. And I think that in order to produce alpha for the long term, you're going to have to go way beyond that.
Okay, Bill, now why? I think that's a huge point about the variation on a theme, the reductive nature of the majority of people in quant and on Wall Street.
Yeah.
Is why people miss the black swan, which is, they say it's a black swan when really it's a higher probability of coming. But when you're reductive, your focus is so narrow.
Yeah. So I think I'll defend it on one hand. Years ago, especially, the only way you can incorporate like deep fundamental research into a systematic process was to reduce it to something that's like tradable. And this was a conversation we would have all the time. They'd say like, well, I have all this value, I do all this research and I know a lot about these companies. And we'd say, that's great, but we need to go back over time, see how you were at making decisions in the end, which are stock calls. And we won't bet on you unless we think you're good. Like, we always use history to predict the future. Predict is probably not the right word, but we need to see history in order to get comfortable that you'll add value to our process, and then we'll put bets on you making those calls in the future. Not only do you need historical data, you need future data. An old data set's also worthless to quants because, well, nowadays maybe it's worth more, but back in the day, like it was kind of worthless because you could say, well, you were great at doing that, but I need your predictions in the future in order to trade on them. Now, I think with inference and AI and tools like that, it may actually provide some value to look at someone's historical work. But the only way you can incorporate someone's ideas into your workflow is to reduce them to some time series that you can use to make bets. And so that's the old way of doing things. Increasingly, you have to get into the deeper analytics, and I'll keep reducing things, right? So now I'm gonna use supply chain, or what I'll refer to as like derivative data. So if you like Apple, that means you also like Apple's suppliers. And one way to express that opinion is to say, okay, what are the relationships between Apple and its suppliers? Like they're going to buy things from those companies. So if you like Apple, you will like its suppliers, and then you can start looking at them and kind of ranking the ones you like and don't like. And so now you've kind of gone into this derivative land. And that's, again, just another reductionist way of like reducing all this work down to like two columns of numbers, and you might multiply them together or something like that. But the outcome is always just going to be, give me like a time series of data that I can plug into a systematic process to make trading decisions. Now with AI and generative AI, I think it's becoming possible to really approximate all of the things that go on in the human brain. And I'm not really talking about neural nets, even though I guess I obviously am, but it's now possible for a systematic manager to incorporate a lot more information and a lot more insight into their process. And so I think eventually we have to get to the third derivatives, forecasting that Bitcoin mining companies will eventually benefit from the AI revolution is, a deeper insight. And so I think you're going to have to get better and better at predicting the second and third things that people are going to invest in when there's a big theme. So you have AI, Mag 7 performs well first, data centers, then Bitcoin miners. And so if you knew about the Bitcoin miners ahead of time when they tanked, it was only like a year ago, well, less than a year, right? So it's 5-6 months probably since those Bitcoin miners were down 50%, from highs before Trump was elected and everything like that. And if you had known then, like, oh, these are pretty good discounts on stocks that I'll want in the future, you would have made, I don't know, you said 5 or 6 times. You probably would have made 10, 20 times. I don't know. And so
You're,
I think that's where a lot of this deep fundamental investing will go.
I think so. I agree, especially with the need to look into sort of second and third and fourth order effects, because also the bar is rising with Gen AI, assuming, which is also not a small assumption, that funds, asset managers, that investors can actually leverage it AI effectively, and not just basically going into ChatGPT and asking questions back and forth. Then it becomes much easier to uncover those second order conditions, third order conditions, and sort of what the impacts of those would be, because ultimately it's just it's about how much information can you synthesize, and what are the insights and the conclusions you can extract, and the relationships you can extract from that information. And so as that bar for quality rises, then you need to go obviously even deeper and deeper to go into sort of next order effects in order to find alpha in general. But also within sort of what you said previously, the first thing you said around how quants can utilize this, and how actually now you can systematize sort of a fundamental investing process into a quant model. That's absolutely true as well, because it was difficult because the process was inherently not scalable. But now you can actually scale it, because if you institutionalize, or if you codify the work of a fundamental analyst that you tend to follow, or you tend to like, or you think he has some good ideas, well, now you can put it into a model, and you can then just deploy that at scale. You can run it across a sector, across a basket of companies, etc. And then the fundamental signals in your quant models can become much more granular and much more detailed, and also much more specific to exactly what you're after.
So, Vlad, I'm going to continue that thought. And what Bill was talking about, second, the failure of, not the failure, but the adoption of Bitcoin miners into the ecosystem of data centers, and that fundraising that's going on with NVIDIA, and the hundreds of billions of dollars. If someone could your system have helped an analyst Discover, I mean, this month, AMD up 44%. You have another Bitcoin miner up 200% this month. You have one up, CleanSpark, 35%. You have Caterpillar in industrial is up 30, something like, I think it was up 20, 30% this month. They're all in the AI trade. Could your system have produced it, or does someone have to nudge it in the right direction to come up with how large that suction was of dollars for seemingly disparate companies for one purpose?
Yeah, I mean, I think it's Quantly is designed not really to say sort of to be the know-it-all sort of. You click a button and then it
Right.
tells you sort of what the trade is. Quantly, the technology can set you up to be able to actually identify some of those trends, but you still need sort of the portfolio manager, the analyst, to have a thesis and to be like, okay, now let's dive deep into this thesis and let's use Quantly in order to actually do this research at scale, for example, and actually identify certain trends, certain insights, etc. So the way, just to take a step back to tell you a little bit more about how Quantly works. Now we build custom systems for investors. So the Quantly fundamental technology is really three modules. It's infrastructure. So basically the model orchestration, sort of how you design the agents, etc., how the different models sort of interact with each other. The data layer, so data connectors and integrations to external data, internal data, etc., to sort of turn Quantly into a single source of truth, on top of which you can build use cases and deploy agents, etc. And then the third part is these workflows and sort of the platform layer, that's where the analyst or the PM can go in and can say, okay, now this is my process. I want to take this process and I want to give it to Quantly so that Quantly can execute, or sort of a suggested process, or just something that I have in my mind that let's see how it works. And you can do that easily. Now, with this specific question, actually, or this specific topic around a whole bunch of companies just being up purely on the AI trade, regardless of whether they are AI or not, whether they're tech companies even or not, that's pretty interesting. We actually, through Quantly, we did a bit of a deep dive into so-called AI washing. So what we did was we did it for Europe. So we did for 50 companies, the Euro Stocks 50. And we created a so-called playbook. So workflow of, okay, now show me which companies are mentioning AI, show me in which context they're mentioning AI. Does this actually make sense? I mean, I'm sort of simplifying, but does this make sense? Like, has there actually been any actual ROI on these AI initiatives that, for example, like Caterpillar or Key is talking about? And most often than not, the answer is no, or can't really confirm. So there's been a lot of this AI washing going on. And if you sort of dive deep into what management is talking about, the initiatives that they're talking about over time, let's say over the past year, you're not seeing too much ROI there, or at least talk of specific ROI. You're only seeing promise. You're only seeing sort of, this is what we're going to do. We're so excited about it. We're investing so much into it. But then where's the result of that? And I think there's a lot of this AI washing going on, which will be interesting to see how that unfolds. And that's something that MIT mentioned as well. An MIT report on the state of Gen AI in business came out saying that 95% of all Gen AI projects actually fail. And we can dive into that. They don't fail because the technology is useless. They fail because companies don't really know how to utilize it in the right way. And there's a huge difference between those two, because the companies that actually do know how to utilize it and to use it in the right way, those are, especially now over the period of, let's say, 1 to 3 years, they will have an edge. They will have a huge advantage over everyone else. They're just throwing money at AI, whatever that means, just to basically be part of this trend at the moment.
Yeah, it's like that wealthy beginner skier walks into the ski shop buying all the, hot out, all the expensive stuff, but still goes down the bunny hill, right? Just wasted
Exactly.
dollars.
That's exactly what everyone was thinking.
Isn't that what Vlad was thinking about?
But that is a very good analogy, and AI is actually getting much better at analogies. I think, getting back to your peanuts analogy at the beginning, like, did you run that through in AI?
No, probably should have. That was just mine. That was my AI, artificial intelligence.
Okay, and so Mark shifted the convert. Actually, I should say I reintroduced Bitcoin. So shame on me. But I was trying to steer the conversation back to me and using AI agents in like massive scale and workflows. And so what I think you talked about at the conference was you were helping fundamental analysts systematize some of their workflow, get them easy access to the tools that they needed. So I believe you were helping an asset manager with industry specific like dashboards and workflows. So you would go in and you would talk to them and you would be able to introduce some technology to systematize some of what they were doing, replace perhaps some of the old tools they were using. And I believe, correct me if I'm wrong, that you're able to use this infrastructure data process breakdown of their modules to implement Quantly. And I think what that means is infrastructure. What can you deploy across all of these industry specific analysts? Like how do you deliver this dashboard? That can be a common technology. And then data layer is, everyone needs data. Some of it's the exact same data. So all the industry specific fundamental analysts need fundamental data. So you can pipe the fundamental like accounting information to each of them in the same way. And then where I think it becomes differentiating is this like workflow. So each industry specific analyst is going to have a very bespoke workflow, a very specific way of doing things. And that's where we think they actually add the most value, right? They have all of this experience. They teach their analysts what they learned over many years. And so you have to come up with an artificial intelligence application to address their very specific bespoke needs. Is that a fair summarization of what you were doing for that specific asset
Yeah.
manager?
Yeah, exactly. Essentially, really sort of customizing that technology to their needs, to their data stack, because that's where the differentiation is. It's in their process, in their know-how, their use cases, and their data. It's not in the which model am I using, basically.
Okay, cool. So that's where I see an interesting overlap between what I'll call the legacy systematic quants. And so what's happened in quant land is organically you had these different domain experts or people who developed a lot of expertise around a specific domain within the quant world. So we, again, reductionists, had an entire team that would look at fundamental research. So these are quantitative systematic processes around fundamental data, accounting data that, and maybe that whole area of fundamental research. And then you have a team around flows and then textual analysis and macro, et cetera. So now in Quantland, I think you have similar, very bespoke workflows that organically all developed over, we'll call it 20 or 30 years, however long systematic equity quant investing has been around. And I think you can apply that same breakdown to them. So now we're not just delivering something to a specific human. These are actually workflows that evolved around areas of quant research. Even machine learning itself would be, what ended up being its own animal. And everyone had to build these things themselves with bespoke technology. This is before Python, made everyone's lives a lot easier. But what I'm excited about is using agentic AI to then extend into quant land. And I think that the analogy with an individual industry specific analyst really applies. And I guess I'll let you respond to that in a second. But one thing I really liked when I met Ivan is you said you're pivoting your business model a bit rather than trying to solve all the problems with a single product. Your goal now is to become nimble to changes in the market. And I think primarily with all the new tech and products and open source things that are coming out, you're componentizing workflows and you're delivering things with components that are easily swappable with new tech. And so I think minimizing switching costs would be the goal there, right? That means a lot to me because I don't want to get stuck with old technology. I don't want to become wedded to old technology forever. The tech debt problem, I think, is multiplicatively expensive. Introducing bugs that exist forever become not multiplicative, it's exponentially expensive. And, like I love the debt analogy. So it's like really high yield debt becomes higher yielding debt, interest is compounding. And if you minimize switching costs and stay nimble to new tech that comes out and you can just swap it out and throw away the old one and replace it, that will be the edge in the future.
Yeah.
And so again, to draw this all the way back to my own selfish needs and things that I'm excited about working on, like if your plan is to really build a AI agent workflow to do a lot of things on a platform level, how could Quantly solve those problems?
Yeah, a lot of things there. I think there is this analogy that can be drawn to sort of to quant systems. Ultimately, as a fund that is effectively utilizing some of the funds that we're working with as well, that are basically utilizing this sort of AI system that is in a way a kind of a digital twin to their PMs and analysts, but also sort of an assistant, sort of looking at things from a different perspective from what they would normally do. It is a combination of analysts, sort of human analyst and system that in the end gets to the decision, which is very similar to basically what, I mean, it's one step back because it's not fully automated, but it's a step closer and you can scale that process as well. And then you have sort of, you're relying on much more relying on sort of data and the technology in order to make investment decisions, which is again, a little bit closer to, I guess, the quant side of things. But yeah, what we've seen is that general doesn't work. So we have a thesis that it may be or may not be at this point a bit of a hot take, and we were one of those companies as well, sort of building a general product in the space that caters to a common denominator within investment research. It simply doesn't work because what that means is that you have a set of sort of, or you have a framework that caters to the same use cases. You have pretty much the same data in there. And as a result, you're probably going to have the same outputs as well, the same insights that you're generating. For an investor to really have an edge in this technology, it needs to be custom built for them. And that's where sort of this modular approach comes in, where we do have the fundamental layers that sort of tend to be commoditized that everyone is going to have. So like the infrastructure layer has to be reliable, it has to be stable. And then sort of the agent interaction, how do you build those agents, etc. That model orchestration, it has to be there for everyone. But on top of that, that can be different from different use cases and different funds. The idea is we have the basics and the rest we can actually, through our experience and through our technology, we can help accelerate to build that custom system for you specifically, where the differentiated insights are. And what you said about actually not being stuck with outdated technology, well, in our world right now, that's a 3-month time horizon. So you can't constantly rely on sort of on one thing. You have a modular approach where you can just plug and play. You can take sort of building blocks out, bring in something else, add additional building blocks on top in order to just stay at the edge, because 3 months later, 3 months down the line, that edge is already moved and you're already starting to sort of try to get rid of that tech debt that you built up just to get there. By the time you do that, you're already again too late because everyone's moved ahead. That's one of the issues that actually large funds have. They have so much tech debt and there's so much process there that very often, even if they have super capable people, and a lot of them, of course, do, they still struggle to keep up with what's out there. And then that's why they switch to, okay, we can't really build it ourselves entirely. Now, let's actually go and buy it externally. When you go and buy externally, you end up with sort of a general tool that, again, you face the same problems. You face the problems of, well, it's actually not good enough for what we want. It doesn't fit specifically into our use cases, into what we want to do with this. And so that sort of becomes a non-ideal scenario. And that's where sort of we try to come in, where we say, okay, well, we're kind of both build and buy, but more like build, I would say. So we help build with our tech. And that shift has been very successful and has been relatively differentiated from what pretty much the majority of the market is doing, which is just building these sort of SaaS agent platforms that are just underwhelming. And we were one of them as well.
I think that's a very intelligent conclusion to reach. And I think emotionally it's difficult to do that, right? So a lot of times you become wedded to things that you've built. And it's really hard to say, okay, we're going to completely scrap this or, revive some of it, but move on from our original business plan and, evolve. So congratulations on making the right decision, because I think that was absolutely the right one. So Mark, you were at a conference in Nashville and Denver recently?
Yeah, 2 different ones. Yep.
Do you know of any startups that can use Quantly, or
Yeah.
what are you hearing out there?
Thanks for teeing that one up. Because my brain It's like we're starting to cycle like college sophomores here, Bill, living in the same dorm, college co-eds. We were at this conference, Vlad. Our sponsor Unchained has a new business called Gannett Trust, and people like me aren't going to be involved in Bitcoin because we don't have custody. And the reason I wanted to talk about it was new firms, startups, if they stay to legacy products that slowly evolve, they're going to miss the ability to engage with new clients. And so at this conference, one was, again, run by this Bitcoin, I won't call them a startup at this point, they employ a couple hundred people, I think. But they're a firm that holds you Bitcoin. Like, what does that even mean? And they do it in multi-sig. I use it. I have my friends use it. And, they're a sponsor, which is why we're going to name them by name. They are the only sponsor we have. They flew me down to speak to a larger audience. And in that audience, not surprisingly, a lot of entrepreneurs are clients of Unchained. And what I've noticed when I finished my presentation, which was called When Doors Close, Windows Open, about like, everyone's like, oh, the Depression was horrible. It's like, yeah, but, State Farm Insurance started in 1935. Think of that, a financial company. 1971, the 70s gave great music. They gave bell bottoms, the fashion industry, gave disco, better or worse. But they also gave people a 20x return on gold if you were alert to it. All the firms down there were very interested in saying, Mark, how are you getting your message? They're more innovative. So the startups are a key audience because people say, well, what does credit have to do with Bitcoin? And there's these new credit firms coming out. But unless they can do, like we said, make that connection to a credit manager and Bitcoin and how they would think about it, they're not going to get the business. So we need to connect because I need to get you in touch with these folks because they're looking to advance their messaging on a marketing standpoint to make partners. And what you're talking about, that kind of combination of not having tech debt, of not being beholden to one oracle, is critical for these companies. Does that make sense about there's that, good thing, bad thing about being an entrepreneur is that do you have the time to make these changes?
Definitely. I think the less debt you have and the less married you are and restricted you are by your legacy setup, your legacy stack, the better you are right now. Because you can actually, just like we were discussing also with Bill previously, but you can basically think fresh and you can say, okay, now let me take a step back from what I know from my whole career of how we've been working in these institutions. And actually, let's see, leveraging what's out there right now. Let's see how I can build this whole thing up and actually focus on the wrong thing and focus on what the differentiator is rather than focus on how do I build up to exactly the same state where everyone else is or has been just because I'm starting up. You don't need to do that. You can rethink sort of that whole infrastructure from the ground up and do it in a much more nimble, much more lightweight, much better way.
Yeah, thanks for that. It makes sense. Like I was with my son this weekend at Denver, at the Denver conference, Bill. 3 of my boys are out there. One guy's into tech and he was saying, oh, Dad, you use Notion? You should look at Obsidian. You can do more with it. It does markups, markdowns. And I'm like, oh, that's great. I really don't even want to know about it. I don't even want to know about adopting that open source platform. It can save me money, give me more latitude. I don't have the time to do that.
Yeah, that's a constant thing when it comes to adopting Gen AI. It's one part is sort of the how useful the technology is and sort of how much time and money it can save you or it can make you or whatever. But a huge part, and actually we're probably starting to realize maybe even the bigger part is just change management. Why would someone that's been doing the same thing for like the past 20 years or so all of a sudden change? And if you tell them, well, actually there's a clear benefit to this, because of X, Y, Z, that's not enough. You need to sort of find ways to engage with these users and to help in that change management process. I mean, what we're doing is we're selling sort of, again, similar to that analogy, but I'll change it up a bit to my own. It's like going to a fund, to let's say a large asset manager, like a legacy asset manager, and telling them, oh, we have agents that you can now sort of build yourself and you can deploy them securely, etc. Well, you're selling a Ferrari to someone that can't even drive. So you need to teach them how to drive first, because no matter the car, they're not going to be able to use it properly. So there's a lot of this educational aspect, training, change management aspect that is even more important than the technology itself. And exactly, case in point, the Obsidian is much better, etc. But like, so what?
So I think I do have to jump in there and put a little plug for my partner, Debbie. I think like as a coach to a CEO, I think you have to be a little careful about insulting your potential clients. If you tell them like you can't drive a car and, compare that. I love the analogy, by the way, but,
And think of that, Bill.
no
Like,
one wants to be told that they're like a 15 or 16-year-old teenager. They want to at least be acknowledged as an adult.
but if you have to
Absolutely, yeah.
tell the person, that there's actually something besides first gear in the Ferrari, then that's a telltale sign that maybe they don't deserve driving it. Ever hear that person just revving that car 30 miles an hour in first gear? It is just mind-boggling.
Well, out here, you see more of them than in many places, and every once in a while, you hear one meet the bottom of a or I should say, the bottom of the Ferrari meets a speed bump, and it's like, and you got to wonder how much that mistake cost. Thankfully, I think, there aren't similar mistakes, like the LLM hallucinates or something, and you can usually just restart it. But increasingly, there is additional risk with hallucinations getting into production trading models and all that kind of stuff. Yeah, I guess we could keep extending this Ferrari analogy forever. In the interest of time, and since we're, about an hour, we have to give you the opportunity to tell everyone where to find you, Vlad. And then I would like to also just, close things out with maybe a rapid fire question or two. So Mark and I do have a chance to, finish off our I'm sure he has a ton of questions. So maybe we'll just bring it down to one but yeah, tell us where to find you. Tell us how people can use Quantly.
Thanks. Yeah, thanks, Bill. So yeah, in terms of Quantly, ultimately, if you were, I think the best time to get in touch with Quantly and for us to basically see if we can help is, let's say you're an asset manager, either starting off or an established asset manager. You've been trying out different AI tools. You have a mandate to actually bring in AI successfully to the organization, but actually it's not as easy as just bringing in ChatGPT and saying, okay, we're transformed. There is much more to that. And where we come in is we actually help navigate that space, and we help look into sort of the AI initiatives and see how we can accelerate and help those initiatives with our technology. And if someone that's listening is thinking about that, or is thinking, okay, let's see how how we should effectively leverage Gen AI, or actually, oh God, we're falling behind because our competitors are doing this more effectively, or that's how it seems at least, then find us at quantly-ai.com or Vlad at quantly-ai.com. LinkedIn, again, super easy. Find us on Quantly, and the whole team is there. I'm there, etc. And so, yeah, I think those would be the best ways to get in touch.
Cool. You can also go to the show notes. So rapid fire, Mark, you get a question after I do, and we'll keep you to like a minute, Vlad. But how should CIOs structure pilot programs to capture real alpha from Gen AI systems?
Yeah, do we have 1 more hour?
No, just a minute.
So I think the best way to do that is, first of all, depending on the stage where you're at, get familiar with the technologies. Again, leverage ChatGPT, leverage Perplexity, give it out to everyone so they can start using it. Track usage and push people to use it. Change has to come from the top down, definitely. And then people will naturally start thinking about use cases or suggesting use cases, etc. At that point, ChatGPT and Perplexity won't be enough. So bring in a partner. Doesn't have to be Quantly, of course. It can be anyone else, but it has to be someone that actually understands the capabilities and sort of and how to build these technologies. And then if you're serious about going AI first, then just dive in right away and start exploring use cases, start building out your Gen AI initiatives, be extremely intentional about what you want to achieve and how good looks like. If you're just sort of doing stuff for the sake of it, it's really not going to work. It has to be a coordinated strategy.
I like that. Be extremely intentional about what you're trying to accomplish. And then, yeah, I won't bother recapping everything you said, but that was a good 1 minute. Go for it, Mark.
All right. When you're looking for people to hire, besides, grooming AI agents, a real person, what are you looking for? We have a lot of college and recent grads on this podcast as subscribers. So what do you want to see in them?
The most important thing in this is basically just natural curiosity, I would say, and sort of being able to tinker with different tools, with different systems. Is system design, and that sort of comes in. That is built up intuition from basically being naturally curious about different technologies, putting things together, sort of hacking things together, for the lack of a better word, because that's what it takes. Someone that is very curious and just constantly keeps up to speed with what they're doing, what's going on in this new startups, new technologies, and always thinking, how can I actually use this for my own benefit? I think that's key. It's not really key, sort of the school that you're coming from or so. That doesn't really matter, or the company. If you're, let's say, actually, if you're coming from big tech, you may be at a disadvantage, I think, in this space. It's just available to everyone and it's moving so fast that real curious tinkerers would be the ones that make the most out of it.
Nice.
You are perhaps a naturally fast talker, but that was incredibly efficient. Thank you, Vlad.
Hopefully also legible and understandable as well, not just fast.
No, those were very good, coherent responses. So thank you very much.
And one last thing, Bill, on the show notes, I wanted to talk about our sponsor, Unchained.com. If you're interested, go to their website on how to hold Bitcoin, because there's 3 things you got to do. You got to understand it, you got to buy it, and you got to hold it. It's a bearer asset. Unchained.com, and use our code, please, 10, NERBARPOD 10, excuse me, NERBARBPOD 10 for 10% discount on your first purchase. Again, we're saying this because I use it. That's where my stack is stored, and they have more products and a great team. All right, thanks, man. Anything else from the team here? Sign off?
Nothing from me, guys, but thank you so much for having me on. It was a pleasure, and I think we could have spoken about this stuff for 10 more hours easily.
Absolutely. Thank you.
Have a good one.
You bet. Take care, Vlad. Thanks, Bill. Hey, guys. If you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.